This may sound so strange to ask it like this, but did we just have a hawkish cut inside of a dovish meeting? Did we just get that?
I don't feel like that was a hawkish cut. I thought that it was interesting that he used the word well-positioned. You opened your remark with that. Well-positioned is the phrase of this meeting. And he went on to basically repeat well-positioned when he was asked, are you really on hold now? And one of the most interesting things was he emphasized this idea that's new to me anyway, that he thinks that the monthly jobs gains are 60,000 overstated. And so he says maybe a 40,000 stated job report is really a negative 20. And that sounded pretty dovish to me. And as he went on in the press conference, he seemed to de-emphasize inflationary risks. He's gone back to talking about break-evens from the tips versus nominal Treasury market, which is appropriate. He's right about that. That's been extremely well contained in the mid-twos for quite some time. So he says he's well positioned, but he really emphasized things like, well, maybe, inflation will tick up because of jobs, being in demand or something, but I don't expect that to happen. He went out of his way to frame inflation as less of a problem. He even went so far as to say they're making good progress on inflation if it weren't for those darn tariffs, So he's trying to carve out some real estate for himself on these things. But when he says he's well positioned, I really agree with him, because at long last, the Fed funds rate is the same as the 2-year Treasury yield. It's fascinating that the Fed has dropped rates 175 basis points beginning a year ago, September, but the 2-year Treasury rate is completely unchanged. So a 175 basis point drop in Fed funds has finally gotten it back down in line with the 2-year. So I think he is well positioned, and he seems pretty clearly focused more on the employment risk of unemployment rising than he is on inflation being a problem. So I think this was sold, was kind of sold to be expected to be a hawkish cut, but I don't think it was. And when you ladle on top of the cut and the language surrounding it with the $40 billion of what some people will call QE, I mean, that's kind of interesting. We've been doing QT for a long time, and all of a sudden, out of the blue, we've ramped up QE, which is probably giving people some hope that there's going to be QE if needed, and I suspect that is going to be the case. One thing that's fascinating is that people keep talking about the Fed cutting rates to help housing. Well, the Fed cutting rates 175 basis points has not helped housing. What's happened is that long-term interest rates have risen as the Fed has cut rates 175 basis points. The long bond, the 30-year Treasury, is up about 75 basis points since before they started cutting rates, and the 10-year Treasury rate is up as well. So I continue to believe, and this has been my thesis since they started cutting rates, and the market action seems to have corroborated my view, that the Fed cutting interest rates is not going to be helpful for long-term interest rates. So today we had the Fed cut, and the curve steepened again. We're out to 230s, out to about 123, 124 basis points. The high this year was 130. So I'm thinking that we might see long-term interest rates actually rise on this more dovish Fed. But I think that this is not a hawkish cut, Scott, in my view.